Hey everybody, welcome back to Investing with Wesley. In today's episode, I want to talk to you about a really tax-efficient plan out there that not a lot of people talk about. Today I'm going to talk to you about the HSA, the Health Savings Account. Let's get into it. Now for starters, just like it sounds, the HSA is a health savings account that you could set up and contribute to that helps pay for medical costs. Think of it like a college savings account, but for medical purpose. In order to qualify for an HSA, you need to be enrolled in a high-deductible health plan, not be a dependent in someone else's taxes, as well as not be on Medicare. Now, what exactly is a high-deductible health plan, and how high is too high, and what exactly is high? It's pretty vague when they come up with these kind of names. Well, the IRS released a publication that explains to you exactly what the limits are for an HDHP. Now, if you're just talking about coverage for yourself, the Goldilocks zones for minimum and maximum deductible limits is between $1,400 and $6,900 a year. If you're talking about coverage for yourself and your family, the limits go up to a value between $2,800 and a max of $13,800 a year. So if your annual deductible for your health plan falls within this Goldilocks zone, you qualify for an HSA. So assuming you do qualify for an HSA, why should you even invest in one? Well, the reason is an HSA is pretty much the only product out there that gives you triple tax savings. So you have retirement accounts that give you double tax savings. And this is tax deductions as well as tax deferment for traditional accounts, or tax-free growth and tax-free withdrawals for Roth accounts. But there's pretty much nothing out there similar to the HSA that gives you a triple tax savings. So the triple tax savings for an HSA starts like this. The first tax savings is with a tax deductible or pre-tax contribution. So all the money you contribute to this HSA plan is completely tax-free, and it gets deducted from the gross amount of taxes you're considered to owe at the end of the year. The second tax saving is that it grows completely tax-free, similar to a Roth account. So already we have a blend of traditional and Roth in this one account. And on top of the fact that your contributions are tax deductible, and that it grows completely tax-free, if you use the money for a qualifying medical expense, then that income that you received to pay that expense is also completely tax-free. So you have a triple tax savings there in this one account. Now, what exactly qualifies as a qualified medical expense? Well, pretty much anything that has to do with medical, dental, or mental health qualifies under this, especially since in 2020 our government introduced the CARES Act. The CARES Act also made available over-the-counter medications qualify for a qualified HSA expense. So you could go to your local pharmacy and pick up some Tylenol off the counter, and that is a completely qualified medical expense, and that money you receive to pay for that Tylenol is completely tax-free. Now, some HSAs out there give you a checkbook or like a debit card so you could just pay right then and there, but others don't. So you will have to save your receipts to prove to the HSA and the IRS in the event that you get audited that all your purchases were actually qualified medical purchases. Now let's just say you needed the money for something that wasn't considered a qualified purchase. Is there any penalties, taxes, or fees that you need to be aware of, similar to taking your money out of your retirement accounts early? Well, any income that's taken out of your HSA that is not for a qualified medical expense, you will have to pay taxes on. But more so, if you take that money for a non-qualified expense prior to the age of 65, you'll also have to pay a 20% penalty on this. So yes, it's a little extreme if you take that money early, but I think we can all agree that as you get older, you open yourself up for more and more medical expenses and medical visits. So it's not unlikely that you'll be able to use all the assets in your HSA towards qualified expenses, because as you get older, you'll probably spend more and more on medical expenses. So the annual contribution limits for a single covered person is $3,550 a year. But if it's an entire family you're trying to cover, that number jumps all the way up to $7,100 a year. And if you're over the age of 55, you can do a catch-up program of an additional $1,000 a year. I know these amounts don't seem like a lot now, but if you combine this tax shelter with all your other tax shelters like your retirement accounts, then they really do add up to make a huge difference come tax season. Let me give you an example. Right now, the standard deduction for an individual is $12,000. If you made $100,000 a year, you'd be in a 24% tax bracket. If all you did was use the standard deduction, That would make your taxable income at $88,000, which is still in the 24% tax bracket. Meaning if all you did after making that $100,000 that year was take the standard deduction, you would owe $21,120 in taxes at the end of the year. But if you were money wise and decided to put that extra income into tax sheltered accounts like a 401k, 457, IRA, and this HSA, let me show you exactly how much tax savings you would have and how much money you'd get to keep in your pocket. So we'll start again with the standard deduction of $12,000, and we'll also throw in a max contribution to your 401k plan, which is $19,500 a year. On top of that, we'll also throw in a max contribution towards your traditional IRA, which is $6,000. And on top of all that, we'll throw in a max contribution to your HSA, which is $3,550 a year. And if the company you work for also qualifies for a 457B and you max that out as well, that's an additional $19,500 in tax savings, for a total tax saving of $60,500. Meaning, the $100,000 worth of taxable income you started with, minus the $60,500 worth of tax deductions you're going to receive just based on investing your money in wise places, making your taxable income $39,500, putting you in the 22% tax bracket. So 22% of the $39,500 that you'd be able to be taxed on is equivalent to about $8,690, which is a giant difference from the $21,000 you would have paid before. So not only do you get to keep all this money that you saved in your accounts growing over time, but you also don't owe as much money in taxes due to these tax deductions. But taxes aside, going back to strictly the HSA, I think the HSA is an incredible vehicle, especially because it doesn't have to work like a savings account where you're making zero interest on your money. You could actually invest the money in your HSA into stocks, bonds, mutual funds, and ETFs, similar to any other retirement account out there. So you have the opportunity to turn the $3,500 a year allowance that you're allowed to put into this HSA into something astronomical by the time you reach 65 and retire. It's just another vehicle that the tax code gives us access to save money on taxes. And in my opinion, it's extremely foolish of you to not use an HSA if you qualify for one. But as far as health savings accounts go, that's pretty much it. I hope you got value from this video, and I really hope I helped shed some light on what an HSA is and how it could be used, and how it also gives you a triple tax benefit, which is completely unheard of. If you got value from this video, please remember to like and subscribe, because it really helps the YouTube algorithm getting my channel out there so that I can help grow and educate more people. Until our next episode, have a good one.